The Little Book of Value Investing by Christopher H. Browne, Understanding PE and Price-to-Book Ratios. Welcome to yourbooksummary.com. As an investor in a stock, you are entitled to a portion of the company's earnings and assets. Value investors seek to purchase this share at a discounted price. This is why value investors need to focus on stocks with low prices compared to earnings, commonly referred to as the PE or price-to-earnings ratio. To calculate the PE ratio, divide the stock price by the profit, also known as the earnings per share (EPS). The inverse of the PE ratio is the earnings yield ratio, which can be obtained by dividing the EPS by the stock price. Using the earnings yield ratio, you can easily compare the earnings yield from the stock with the returns on other investments, such as risk-free treasury bonds. When analyzing stocks, Wall Street analysts focus on two PE ratios, trailing and forward. The former calculates the stock price concerning the company's recent annual earnings, while the latter looks at future earnings estimates. However, it's important to remember that future earnings predictions can be difficult and may not always be accurate. Value investors like Graham preferred stocks with stable earnings histories and future expectations similar to past performance. In contrast, growth investors are more willing to pay higher prices for anticipated future earnings. It's also worth noting that when calculating the PE ratio, it's wise to look beyond accounting earnings, as they may include many discretionary items and assumptions. Many analysts prefer to use cash flow or EBITDA instead. Regardless of the market conditions, buying stocks with a low price relative to earnings is generally a smart investment strategy that can lead to good returns. While staying the course during a bear market can be tough, those who invest in cheap, out-of-favor stocks can expect to see solid returns over time. Investing in stocks can be a great way to buy earnings at a low price, but sometimes, stock prices can fall even lower than the actual book value of a company. Many successful investors have profited by purchasing stocks for less than their book value. It's not uncommon to find stocks selling for far less than the book value of their assets. For instance, in 2005, a Korean flour mill sold for less than a third of its book value, while in 2003, a Swiss conglomerate and Volkswagen were selling for about half of the book value. Companies can sell for less than cash, as many Japanese companies did in the 1990s. Global investing is a sensible option to diversify and potentially find value because international markets offer an array of bargains. However, accounting practices can differ among countries, adding complexity to your task as a global value investor. Nevertheless, if you are willing to learn the differences between accounting practices, you can unearth treasure in other countries. Of course, as international accounting principles converge, this type of analysis becomes more manageable. It's essential to confine your investments to developed countries to ensure economic and political stability. Emerging markets carry too much risk. I hope you found the information about the Little Book of Value Investing by Christopher H. Browne. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I'll see you in the next video.